more commonly, we talk about a portfolio of projects. And portfolios are we're going to talk about it in two contexts here. All of you in your 401ks, you will have a portfolio of assets. You'll have mutual funds, you'll have treasury bonds, you'll have corporate bonds, you'll have your human capital, you'll have your house, you'll have your car, you'll have a whole range of different assets. And that will comprise your personal portfolio. As managers, when you're managing a healthcare program or a service or a wing or a hospital or whatever, you will have a variety of assets that are generating revenues and costs, and those are a portfolio of assets as well. So that's the context we're going to be talking about. Portfolio of investments personally, or a portfolio of assets as a manager. When you talk about a portfolio of investments or a portfolio of assets, you have to look at the risk of the entire portfolio. And we do that in the following way. So we've got a simple example here. We've got 4 different assets, A, B, C, and D. So you as managers, you as individuals can invest in A or B or C or D or some combination of all those. So what do you notice? And at the bottom of the graph you can see ER, which is the expected rate of return, and you can see sigma, which is the standard deviation. So what do you notice about in the shaded portfolios? Suppose we combine A and B in equal proportion. So we've got $1,000 to spend, we put half of it in A, and we put half of it in B. What do you notice about the outcome?
Neutralize.
If what, sorry?
They neutralize.
They neutralize each other. Okay, could you explain what you mean by that?
They balance each other out. Because they're negatively correlated.
Okay, how, when you say they balance each other out?
It eliminates the risk.
Okay, and why? Okay, so you say it eliminates the risk because, and what's the evidence you have of that?
That there is no variation depending on the result. There's no variation in the return.
And there's actually a number here that proves that statement.
0 sigma.
Right. The fact that the standard deviation is 0 means that there is no variation in portfolio AB. We have in fact created a risk-free portfolio.
But how? Did you add up the expected rate of return? Like how does sigma become 0?
Okay, where's the C in AB, the first line in AB, very poor. What do you notice about, as you go down the column of AB? What are the expected rates of return in each state?
Increase.
No, in AB.
Oh, it remains constant.
Right. Every state of nature produces a rate of return of 10%.
So it has nothing to do with the initial columns, column A and column B. I shouldn't be comparing.
It does. Where are those 10? Where's that 10% coming from?
Is it the average of those?
It is the average of A and B.
Oh, okay.
So half of negative 10 plus half of 30 is 10. Half of 0 and half of 20 is 10. Half of 10 and half of 10 is 10. And the reason is because, as was pointed out, is that security A or investment A and investment B are perfectly negatively correlated. When A is high, B is low. When A is low, B is high. By combining those two assets into one portfolio, we can create a portfolio that pays off 10% in every state of nature. It is riskless, as indicated by a standard deviation of 0%. There is no variation. There is no risk. Question. Does everybody understand where that 10% and the 0% is coming from? This is really key to risk analysis. It is the correlation between the cash flows of different assets. What's happening in AC?
They are positively correlated.
Exactly. So AC, what's happening to the risk and the required rate of return?
return is increasing and the risk is increasing also.
So if you notice, AC, the expected rate of return is half of A and half of C, the 12.5%. And what do you notice about the sigma? Compare sigma of A and C with AC. It's higher. It's average. It's halfway between A and halfway between C. So when assets are perfectly positively correlated, there is no risk reduction. It's simply the weighted average of both assets. Finally, look at AD. This is a little more difficult. What do you see? Hard to tell, but what would you guess? Just eyeballing it. Is it perfectly negatively correlated?
No.
Is it perfectly positively correlated? Somewhere, it looks positive, but not entirely positive. So what happens in this circumstance? Well, the expected rate of return is still half of A and half of B, but the sigma is less than both A and D. So what's happened? The risk has gone down. Even though they're not negatively correlated, they're not positively perfectly correlated, the risk of the portfolio has gone down. So this is the key to all risk analysis right in this table here. If assets are perfectly negatively correlated, that reduces the risk of the portfolio. If assets are perfectly positively correlated, there is no risk reduction. And anything less than positive will lead to some risk reduction. So as you go from +1 to -1 in correlation, the amount of risk reduction, what happens to it? As you move from +1, which is perfectly positive, to -1, which is perfectly negatively correlated, what happens to the amount of risk reduction? It increases. So even if two assets are correlated 0.99, there will be some risk reduction. And the fact, if they're correlated -1, that could be a lot of risk reduction. Any comment? Yes, Vic.
So then that 10.1%, I mean, the fact that the risk is lower, it doesn't mean that it's between that 0 to -1 range, right? It just means it's lower than 1.
It just means it's less than perfectly positively correlated.
Okay.
If it is perfectly positively correlated, like A and C, then the combined sigma is halfway between A and halfway between C. The fact that AD is less than both A and D tells you there has been some risk reduction.
So anything between -1 to like 0.99, that means there's risk reduction?
Yes,
Okay.
but not the same amount.
Okay.
You got it. So the expected return as on the portfolio we talked about, the portfolio's risk, as I just demonstrated, is not just the weighted average standard deviations, but it depends on the relationships, and that's the correlation. And the correlation, as I just stated, +1 is perfect positive, -1 is perfect negative, and 0 means there's no correlation, it's random. Some real-world correlations. The correlation between the Standard & Poor's 500, which is a widely used measure of the stock market, and foreign stocks is 0.6, gold stocks is 0.3, treasury bonds is 0.21. So in the real world, one question you may be thinking to yourself is maybe we should be looking for assets that are negatively correlated. And if you are risk averse, that is a desirable thing to do. In the real world, such assets are very difficult to find because almost all assets are correlated with the Standard & Poor's 500 here. Why is that? What's happening at 50,000 feet? Oh, yeah.
because most assets will move with the economy. So if the economy is doing well, companies will do well.
Exactly. All of these assets, almost all the assets in the economy, will be affected by the general level of economic activity, interest rates, taxation, trade, and so on. So it's not surprising that you find these kinds of correlations. So the next thing we want to talk about is, okay, we've talked about a two-asset portfolio there, A, B, AC, and AD. What happens if we start adding 3 or 4 or 5 assets? And what we find is that the risk of the portfolio goes down the greater the number of assets that are added to the portfolio. So you can see example here, the risk of one stock is much greater than the risk of a few stocks, which is much greater than the risk of many stocks. Which is why we have mutual funds. Mutual funds will have 300, 400, 500 different stocks in them. They're diversifying their portfolios, and you get to buy the assets. So you can diversify through the mutual fund. That's why this is happening. There's a certain amount, basically what this is graphing is the amount of risk on one axis compared to the number of investments in the portfolio. What that shows is that when you have one asset, you can greatly reduce your risk by having 2 assets. But when you go from 2 to 3, you can still reduce your risk, but not as much. So it's gradually declining until you reach around 80 or 90 assets, and then it levels off. And the reason it levels off is for the reason that Jorge was just talking about, that there's a certain amount of risk in the economy that you can never diversify away. You can diversify away the risk from 1 or 2 assets, but you cannot diversify away the risk of the economy. So we talked about standalone risk. We talked about diversifiable risk. That's the amount that you can eliminate by adding different assets. And then there's portfolio risk, and that can't be eliminated because that's subject to the general economy. So what does all that mean for you? And I will emphasize this over and over again. It is not rational for you to own one asset. There's a reason we have mutual funds. There's a reason why we have the wide array of investment products. Diversify your portfolios. Think about the poor folks who worked for Enron when it went belly up. A lot of them had a lot of their personal wealth in Enron stock. And they had Enron pension plans. So when that organization went belly up, they lost their pension plan, their personal investments, all their human capital. That's a very big error that you won't want to make. You want to diversify your portfolios, whether you're an investor or as a manager. And secondly, because you hold one asset in relation to other investments, standalone risk doesn't make much sense.